to a special episode of Smart Real Estate with Westcliff. I'm your host, Addy Saeed, and with me is Jaffer. Over the past 10 episodes, we've explored a range of topics aimed at helping you master the art of real estate. What we're going to be doing in this episode is doing a recap of the episodes that we have done and what they represent, and some of the lessons that we can share and some of the thoughts that we have, afterthoughts that we have on it.
Yeah, for sure. It's been a great second series here, Addy. I can't believe we're approaching the quarter century club here at almost 23, 24 episodes. Quite an achievement so far. I'm looking forward to diving in. What was the first episode we did in the series? Do you remember?
The series was called Real Success in Real Estate. So as a recap, our first one that we did is called Transforming Underutilized Properties.
Well, there's definitely some properties that were underutilized. No, I'm kidding. The opportunity there, when I talk to real estate investors, the biggest thing is really trying to find that hidden value, right? Almost that diamond in the rough. One person's treasure is another person's garbage, and really be able to find those opportunities, I thought was a good part about the episode. Sometimes in a property today could be zoned a certain way. And in fact, if you can find a way and understand where that neighborhood is headed, you can have an opportunity to really transform the value of that area.
No, it's a very, very valid point. So a lot of times in our sales business, even we can see that different buyers are coming in and underwriting properties differently. So one buyer will have different assumptions on what they can produce as a result from that property versus other buyers that would produce a different result. Even though both parties have the same numbers, they are underwriting it in different ways and generating a different return for that investment. Transforming Underutilized Properties was a great episode where we talked about different hidden potentials that we can see in the properties and also how to make strategic updates to boost the value of the property.
Yeah, the upgrades are an interesting one, right? Because, the upgrades, different folks and different investors could underwrite them differently in terms of what that upside could be from that upgrade, right? So as simple as whether it's unit turns or increasing the amenities, things like that. How does that really drive, your view versus mine versus another investor could be quite different, which could really drive a different underwriting and investment decision.
Yeah. And the market where the property is located is very important as well. So if you're in a market where there's not a lot of luxury items or the rents are not really high, going and over improving a property can have negative consequences on your bottom line. So it's very important to have strategic upgrades completed and do some math beforehand to understand that the upgrades that you're doing are going to be able to generate a return that are within your target or your wheelhouse too. The next one we had after that was large scale development. So how do we measure large scale development success? What does it look like? Do you remember anything about that episode? What are your thoughts on it?
Yeah, the big thing on large scale development is it's planning, right? Not even just the planning around the traditional way, which is the zoning and working with the city and then the municipality, but just on your own end, understanding up front, getting the right team in place. So getting that, whether it's the right architects, engineers, surveyors, et cetera, getting that whole, dream team together, really being methodical about the space and really trying to understand what are the opportunities. When you think about large scale, you're literally building us because you're not turning this thing around in 12 months. This is a 4 or 5 year, potentially longer development period. So I found the clients that you and I have worked on, it's that multi-year, multi-phased community, more global approach I found is a real way to really drive success.
And also finance piece is a really big piece over there. Your interest rate risk is really high. Depending on the spectrum where you are in the development, you have different risk profiles that you need to be considerate of. You could have zoning risk if the property is not zoned. So you go through that and now you have a development risk where you're actually getting the property encumbered. Once that is done, then you take it to the next level. And as you're growing and building that property up, you have different set of risks that are coming into play. Finance risk is a big one as well. Interest rate risk, you have your construction risk. So all of those things need to be considered. And how do you cover your downside? That's a very important factor in the life cycle of a development too.
You bring up a great point there on the financing. Given the multi-year nature of it, the fact that you're literally transforming the space, the financing and the capital stack gets quite complex, really making sure that you may have multiple players, first mortgages, seconds, multiple, pari passu, all sorts of things going on. And so it's really important that you really look at that more strategically, got the right partners at the table, gone to market, and then, as you said, mitigate against interest rate risk, right? In terms of, whether it's going up or going down or prepayment risks. There's definitely much more complexity in those kind of arrangements.
This is also a prime example of where investors like LP or equity investors can come in and take part in these large scale developments as well. So one of the portion over here is raising money. So a lot of times these developers, they're looking for money to build these projects, and companies like Waverly, where we're licensed, comes into play for those opportunities where we can bring capital in on these projects and help investor invest in these projects too. And that's another piece, how investors see and generate different returns based on the investments that they're making. A developer versus an LP investor will see different returns being generated based on the amount of investments that they're doing and amount of risk that they're taking as well. So next one we had was turnaround projects. What do you remember about that episode?
So typically these are the buy low, sell high scenarios, right? Where you might have an opportunity, somebody's underperforming, their asset might be underperforming. Given the last 2 years where people have had, interest rate and other challenges, you might see a little diamond in the rough again, right? Looking for that opportunity. This is a scenario where it could just be a tenant mix issue. Maybe you don't have the right zoning. And so the right kind of strategy, patient capital, and it could really allow you to pick up a great opportunity to turn this thing around. And maybe what used to be a empty apartment building could be a really well-performing shopping plaza, for example.
No, it's a very valid point. We're seeing a lot of activity in the market right now where there are vacant properties that are coming, and vacant properties in Ontario represent quite an advantage over properties that have tenants in them because Ontario has rent control. So any property that is currently vacant, you can take that property to market rent right away, and your cap rates would be so much better on it. Also, investing in cost-effective upgrades was an important piece there, making sure that you're doing upgrades that are going to actually help reduce your operating expenses and also generate more money in your bottom line. Next one, we had steady income from multifamily units. This was a really nice episode. I really enjoyed this one.
So when you look at multifamily units, the big thing there is being able to capture the rent, efficient turnover of units. And when you do turn those units over, making sure that you've got a good plan around whether you're upgrading appliances, you're doing hardwood, like it depends on how you're trying to turn those units, but kind of being efficient with that and really having a good eye around operating costs. For a lot of investors in multifamily, this can be challenging where you've got a day job, maybe your investment may be a secondary duty for you. And so that's where getting a really strong property manager on the ground, support from a good leasing team. And then I'd say overall, the biggest thing that really moves the needle for folks is really having it professionally asset managed, right? So having people who can put eyes and ears on the ground for you, hold your property managers accountable, hold your leasing agents accountable, because for every month that unit's not leased, that's burning a hole in your pocket. Your mortgage still has to be serviced, property taxes still need to be paid. So being really efficient around that. So I think sometimes people think of, property management or some of that on the ground stuff is a bit transactional, but a few points here or there can significantly move the needle on returns.
It's a very valid point. I remember walking through a building where the whole top floor was actually vacant because the roof was leaking and the owners had not gone through and repaired the roof. And they were losing a lot of money on this property. And it was also damaging their building. So those small things, they play a big role in the profit that you're generating. Also making sure that when you have an asset manager, they can actually set up a plan for success for the asset that you have. A lot of times property managers are looking at managing the day-to-day activities. You need somebody to be there that can actually drive a larger or longer story. So if there's redevelopment potential in the property, you need to take steps today and have a plan in action that can help you achieve those targets that you're looking at getting to. Another episode we had done, episode 5, was high return investments, where we talked about emerging markets and infrastructure projects. Kaz, do you want to fill us in on what some of the other items were?
For sure. So on the high return strategy, I think you really need to have a nose to the ground. You have to understand where that area is going. You're trying to get in there almost like a quick flip strategy where, maybe that area could be densifying. There could be opportunities where maybe a new transit is being built or hospital or different things like that. So try to take advantage of those areas, even making a profit on the lift in terms of trying to rezone from, let's say, again, retail to multi-res or things like that, where somebody else can come in and actually build it. Sometimes we walk into a site assuming we're going to own it and go all the way through. But in fact, sometimes the strategy could be let's do a bit of an assembly, bring it all together, and then flip it for a much larger return. There is more risk involved when you do take a quick strategy like that. And so you have to have some mitigating strategies to offset.
And that was episode number 6. So risk mitigation in action. So what were the different things that you can do to mitigate or cover your downside? Diversifying across different property types and locations was one. Conducting thorough due diligence. That's very important. When you're buying these properties, you want to make sure that you're doing a thorough due diligence and understanding what you're buying. Buying a retail property is much different than buying a residential, multifamily, or even land deal is completely different. The set of due diligence that is required is completely different. The financial due diligence is different. Your projections are very different. And through all of this, you're usually going to have a finance piece in there, and you need to have a cash reserve to offer you flexibility. There's nothing worse than running out of cash in the middle of a project, especially when you're working on a large project. Guys, any other thoughts that you had on that?
I think in the due diligence, sometimes that's a bit of that can be missed or not done as thorough. People get the deal under contract, they put the first deposit in, they think, great, now we're ready to close, but they haven't gone through the additional steps there, or maybe an environmental assessment, classic area that you could, maybe there's some additional, maybe there's litigation against the property for all you know. Like there's all sorts of things that beneath the surface isn't there. So, I really recommend, and we recommend, to bring in the experts required. When nobody knows all these different rules and all these different things, that's why you bring in a really qualified team to make sure, because that extra few bucks, a few $1,000 on some professional fees could really benefit you from potentially making a big mistake, or at least be able to go back and what we call retread or get paid for that from the seller. They're going to disclose what they disclose, but at the end of the day, you've got to do your homework. It is your money and your investor money that's moving forward.
Yeah, no, it's a very valid point, especially when you're doing due diligence. Bringing somebody in who knows how to deal with these properties, it's priceless. I'll give a simple example. A lot of times, not picking on lawyers, but lawyers will not go in and confirm the actual number of legal units in a property unless you specifically give them instructions to do so. If you don't give them instructions, they will not. You will be relying on marketing material from the seller that this unit has X number of units. Now, if the seller is smart and they know the details of it, they will tell you these units, they're legal, these units, they're not. So this is the total actual number of units. If you're not careful about this and you go to finance it, let's say through CMHC, all of a sudden you're actually losing the amount of money you can finance. That property is not worth that much money. CMHC will start discounting the cash flow that those rents are being generated from units that are illegal. And that will negatively impact your project returns. It will negatively impact the mortgage that you can get and the value that you can sell it at in the future. So it's very important to make sure you're doing proper due diligence and working with people that understand how to evaluate these properties when they're working on them. We also talked about eco-friendly developments in episode 7. Kaz, do you want to take it away? You're like the development guy with me.
The eco-friendly stuff is just a great passion point, right? In terms of tenants, everybody's kind of heading in that way. Any opportunities we can, whether you see geothermal, solar energy, different tax credits and incentives that are being offered. In some cases, it's almost free to do this if you position it properly. And so back to the expertise side of it, get those assessments in, see if you're building your opportunity, see if you're able to take advantage of some of these credits that are out there. This is like money that's out there, and you'll have higher upside potential for your property. So if you compare one property to the next, one with eco-friendly or energy-saving, features will very much have lower operating costs, higher NOI, higher value, and also just more desirable for investors.
Yeah, on the flip side, you also will see buyers that are environmentally conscious actually pick your property and be willing to pay a bit of a premium on top of it. So your rents would be much higher too. So there's a strong case to be made. On the back end, you can actually get grants from government. So I'm just picking on multifamily again. So CMHC has the MLI Select program under which they have an efficiency banner. So under the efficiency banner, if you can increase the efficiency and make it more environmentally friendly, you can actually get longer amortization periods, lower down payment requirements, and a host of other features too. It moves the needle enough that you have to pay attention to those things.
Yeah, the only thing I would add to that as well is that when you're looking to sell potentially your property or development, a lot of the real estate income funds out there have sustainability targets, net zero targets. They're looking to add to their portfolio to meet these kind of targets, which is important for their investors. So all of a sudden, your property really differentiates itself and steps out from the rest of the population, giving you potentially a price premium when you go to some of these large funds that are looking to build out that eco-friendly portfolio.
Rehabilitation and renovation wins, we were looking at it at episode 8. Our main focus over there was to prioritize high ROI upgrades like kitchens and bathrooms, manage timings and budgets carefully, and staying compliant with local business codes. And this goes back to talking about number of units. If you're looking at adding more units, make sure you're talking to the city and having an architect, have a team in place that can actually do all the due diligence for you, and making sure that you're not going to be offside. Anything else that you wanted to add, Kaz, on that?
Really on the ROI side, a numbers guy, the first thing I look at is, I think it's important to walk the unit with some professionals, really not even the unit. I mean, the entire asset, walk the property, understand what the opportunities are, and just like a shopping list, itemize all the upgrades involved and what's the payback. Also, the one thing that I noticed in a lot of underwriting models when they're trying to build out these upgrades is the timing of the upgrades. How soon can these units actually turn? Can we actually generate the profits? Trying to turn a large number of units on a monthly basis. Obviously, your returns go very high and the numbers look good, but is it realistic, right? And so running optimistic, a standard, as well as more of a conservative scenario allows you to kind of understand the opportunities there. And of course, that can impact as you increase the income, thinking about future financing, right? So as your value of your property has gone up, now is there an opportunity to go back to your lender, get a second mortgage, refinance? All of a sudden, there's great opportunities to take additional funds out on a tax-free basis.
And going back to, we're talking about due diligence again. And as part of due diligence, this is something that you should be doing. One of the things that we do anytime we're buying a property is walk through every single unit, and we have a sheet where we actually make notes on the upgrades that need to be done there. Does the place need to be painted? Yes. Needs new kitchen? Yes. Needs new toilet? Yes. Needs new tiles? Whatever it is. So step by step, and we just check mark all of it. Then it gets inputted into a master spreadsheet, and now you have a budget. Now, anytime that unit is going to turn, you know exactly all the upgrades that you need to do. You always budget a little bit more depending on how far along you are. And you can, with quite a bit of accuracy, predict how much your turn cost is going to be and how much profit you can make on that turn. Next one, we had navigating market downturns. This is something that we're struggling with right now. The US election just went through. The market did pick up, but it didn't pick up. There's a lot of uncertainty. There's a lot of headwind for Canadian real estate and Canadian markets in general. We talked about how to work against that headwind. Kaz, what can you tell us about cash flowing properties and what we can do in this market?
Absolutely. So this is a scenario where you really need to play defense so you can play a really strong offense. So from a defense perspective, making sure you've got access to your, liquidity, whether that's cash on hand or if your existing properties have available, HELOC or lines of credit or things like that. So you can seize those opportunities on the one hand. Secondly, if you have any properties or any investments that are variable rate debt, you want to make sure you've got reserves set aside in case, with the downturn, rising rates, you're protected well in those scenarios, especially if you have vacancy where people might have moved out, maybe your tenants, if you own some commercial properties, we've seen in the past where tenants aren't able to pay rent during those periods. Well, you know what, if the tenant's not paying rent, you've still got costs that need to be run. The taxes have got to be paid. So really just that defense with a lot of my clients, we focus heavily on making sure you've got that defense so you're able to then play offense, because the other side of it, opportunities will come up. People who haven't played that defense are now running into some trouble. And so there you can sweep in there, bring in investor groups, syndicate some investors together, yourself, however you want to do that, and go and take advantage of some opportunities. Again, making sure before you go offense, really making sure you've got a really strong cash and foundation to be able to execute.
Yeah. And the best point about this is that this has to be played, like navigating market downturns has to be played in good market. So this defense, you have to play in good markets so you're prepared for it. Nobody knows when the market turns signs, but by the time you see the signs, it's already too late. Your defense should be played while you're on offense as well. So when you're doing your underwriting, making sure you're underwriting conservatively, making sure that you are stress testing the asset that you're buying, and making sure that if everything goes to HEL in a handbag, what is your exit strategy? What is it that you can do with this asset if nothing goes as you plan? Last one, we had innovative financing solutions. I didn't even have to say anything. Kaz, you want to take it
I
over?
think this is a good one. This is innovative and financing go really well together. Again, we've talked a bit about some of the defensive strategies. Having said that, I think the important thing is, don't just go to your local bank, right? That's the standard way to do that. Even if you have multiple loans with them, that's great and that's nice, but also you want to keep them hungry, right? So work with other lenders, there's debt brokers out there. There's lots of many people are willing to lend out there, provided you're in a credit position and a strong position to do so. So get creative. Seller financing, the return of the vendor take back the last few years has been like unprecedented level. I mean, Addy, I don't know if you want to add how many, VTBs you've seen in your time the last few years have really come up a lot.
It has. And it's funny that you would never hear anybody talking about VTB. You would mention the word VTB and the vendor would say, nope, not interested at all. And now you actually see it on MLS listing saying that vendor is offering VTB. There's one deal we're working on where the vendor was offering, it's a $2.5 million deal. The vendor was offering up to $700,000 in VTB. And the reason they're offering VTBs is because they want to do capital preservation. So they want to keep some of the capital that they have. They're seeing property losses and they want to manage that. They want to preserve their capital. And also they want to make their deal more attractive for other investors that are looking in the marketplace.
From a seller perspective, also, there's always an opportunity by offering that BTB from a capital gains deferral standpoint.
Is there a limit to how long they can defer it for?
It's 5 years in most cases. But again, we would obviously want to consult and review that professionally just to make sure your tax situation isn't impacted through multiple circumstances, but happy to take a look if folks are interested in having that conversation.
All right. So the other item was the hard money loans for short-term projects. If you have something that is short-term by nature, something that you're doing a quick flip on, there's money available. There's always investors that are looking to invest money in small projects that have quick turnaround, anything from 3 months to 12 months. They're investors that are always looking for projects. So that's 20 episodes now. And now we're jumping into our series 3.
Yeah, good recap overall, Addy, on series 2. Now, if we look at just overall how Westcliff can help, our approach is really threefold. It's called raise, invest, and manage. On the raise side, we help our clients with finding investors, securing financing, the capital raise side. So making sure you've got the funds you need to deploy on your strategy. From an invest perspective, now, we are, as Addy had mentioned, we are a licensed dealing representatives, both Addy and I, through Waverly Corporate Finance. And so we're able to help you, whether that is raising capital from accredited investors and looking at opportunities within the market, whether that's passive or active investment opportunities. And on the managed side, there we provide professional asset management services, whether that's on the finance accounting side or operationally for your assets, overseeing some of your property managers, again, to ensure that you achieve success for your investments. If you'd like to hear more, you can call us at 647-799-2264, or you can visit us on the web at www.westcliffam.com.
And one thing I should point out that if you need help with due diligence on your transaction or you're thinking about buying, don't be afraid to reach out. We're more than happy to take a look at any investment opportunities that you're looking at and providing a second opinion. And again, guys, please remember, while we are professional, this podcast is for informational and entertainment purposes only. Always seek personalized professional advice from a qualified professional before making any investment decision. Thank you for joining us for this episode. Hopefully you'll stick around. We have about 70 more to go, and we're going to start with number 31 next week. Take care, and we'll chat with you soon.
Thank you.